one of our early modules with Monica Halan, we talk about the importance of creating different accounts into which you put your money. Something for saving, something for emergency, something for investing. At that time, we had also cautioned you a little bit about how when we start putting money into different accounts, we start treating the money differently. This notion of something known as mental accounting is a cognitive bias that many individuals all over the world have. These and other such cognitive biases are what I want to talk to you about topic today. Let me start this discussion of cognitive biases by talking about a situation that many investors very frequently find themselves in. Suppose you're in a situation where you own two stocks. On one of them, you're sitting on a profit, on the other, you're sitting on a loss. Which one should you sell is a decision that people often find themselves confronting. Usually, it's because they need the money. Sometimes it may be even if they don't need the money. But whichever it is, this decision on which one to sell has a cognitive bias story associated with it that I want to kind of highlight for you. But before I say that, let me also say, just to set the stage, you haven't taken the loss yet, you haven't or gain yet, you haven't realized a profit yet, it's on paper. What paper simply means is that something you bought for 100 has now gone up to say 140 or 150, you're sitting on a 40% or 50% paper gain. Until you book the gain, it is still on paper. Booking the gain and realizing the gain are two ways of saying the same thing. So let's continue next on how the cognitive bias might work for you or against you. So suppose now that you have an urgent need of cash and you have to pick one of these two stocks to sell. Remember, one had a paper gain and the other one had a paper loss. The most common thing that I find people doing is that they sell the stock on which they had the gain, thinking probably that at least that gain was somebody else's money that came towards meeting your urgent cash flow needs that caused you to sell the stock in the first place. What I would argue, and I want to convince you of, is that people choose to sell the winner and not the loser because they have something against realizing a loss. The notion here that I want to sort of highlight is very simply that somehow when a loss is booked, when a loss is realized, it becomes an actual loss and you are faced with having to deal with it. As long as it was in paper, it's almost as if it didn't count. Taking a loss, booking a loss, realizing a loss is tantamount to admitting a mistake, to admitting that your original investment thesis that drove you to buy that stock in the first place was incorrect. And many of us have real trouble, including myself, many of us have real trouble coming to accept this. This is a notion of what economists call loss aversions, the tendency to not want to take a loss and confront an error. In fact, there have been many studies that have shown that people are twice as bothered by a loss as they would be pleased by an equivalent gain. The rational way to decide whether you should sell the winning stock or the losing stock really should be done by examining the investment thesis that got you to acquiring the stock in the first place. What I generally try to do for myself and urge other people to do as well is that when you purchase a stock or any financial investment, think in terms of a target at which you expect to get out, because that seems like a reasonable price for your investment to reach. That helps with trying to figure out when to exit and which one of these winners or losers to exit from. If, for instance, the winning stock has really good prospects, then why are you taking those gains by selling the winner? If in turn the losing stock has really not that good a future ahead of it. Why are you hanging on to it? You should be selling it instead. But it's again that loss aversion that kicks in to prevent you from taking that step of accepting a loss and moving on. There are lots of stocks. There are lots of opportunities. Why are you obsessing over one? And sometimes, instead of taking that loss, people actually make it worse. They double down, thinking that by reducing their average price, the stock is somehow more likely to come back. Looking at your investment thesis is what you should be doing, and people don't do this. Remember, the market doesn't really care what price you paid for a stock. Only you do. Sometimes I think that not knowing the price you paid for a stock might not actually be such a bad thing. That way you won't obsess over it, you won't stress up over it, you won't double down upon it. This has to do with another kind of cognitive bias called anchoring, which we can talk about later.